Welcome back, dividend and value investors. If you are new to this channel, welcome. I am European Dividend Growth Investor. On this channel, I discuss anything dividend investing related and with a strong focus on stock analysis. Having said that, I would love to share my thoughts about Unilever earnings today with you. It is an iconic European company that has not been performing well in the last few years. At the same time, it's one of my core positions in my portfolio, so I want to keep a close eye on its performance. I also know that many of you own some Unilever, so I thought it would be worth to give my quick take on the earnings today. Let's get started. So first of all, in conclusion, let's start with that. The Unilever earnings look quite well. If you think about this inflationary environment, the company has been able to pass on most of the inflation costs to its customers because it has an underlying sales growth of 8.1%, which is composed out of 9.8% of price, and that of course at the cost of some less volume. This is normal, I would say, because not every customer will accept a 10% hike. Having said that, if you look also at the numbers further, an operating margin of 17%, a little bit lower than last year because the price as such was not able to compensate for everything. That's why we see a little bit of a lower margin. But at the same time, an underlying earnings per share of 1.34 euro. I usually use the deleted here one according to GAAP, which is 1.13 euro. The good news is it's easily covering the dividend. The bad news is the dividend is still the same for the 6th quarter in a row. I'm really hoping that with these numbers, the company builds some confidence, at least for another hike this year, so that we keep the growth track record and that we keep up a little bit at least with the inflation that we are seeing. What is also good to see is that the earnings are impacted by currency and we're not there yet. Expect more to come in the upcoming quarter. The company also shared that in their report. At the moment, they are having earnings based on a US dollar of $1.09, which is from 1.20 last year, but we know it's currently at parity. So expect in the upcoming half year and quarterly earnings report still currency impact, which is favorable to the company, right? So this is probably good to mention. I'm not talking here about negative impact. I'm talking here about favorable impact, which means that the earnings still look a little bit worse than the highlights show us. So next part I would like to highlight before we go into the financial statements really quickly is their raised guidance. So effectively, if you read the headlines in the news today, it will show all about the raised guidance. Well, what is it really? It's not that much, I would say. It is only saying that their guidance for the underlying sales growth in 2022 was first 4.5% to 6.5%, and they are now expecting sales growth to be above that range, driven by price with some further pressure on volume. So effectively, just the price hiking is leading to sales growth, the no-brainer. But for the rest, the guidance is all the same. Operating margin, 16%. And then they continue to expect to improve margin. So this increased guidance is really meaningless in my opinion because of sales growth, but it doesn't mean anything to the bottom line. Okay, having said that about the bottom line, let's quickly go to the financial statements before we conclude this video. So here we can see it. If we look at the first half year numbers, constant rates, I want to look at 10.2% more sales, but through 3.4% less profit before tax and 8% less profit. This is if we take currency into account, otherwise it would be 5.3% less. What is really important to know here is that a lot of this has to do with taxation. The company had a higher tax bill this year than last year. Now, don't think that that something is wrong this year. No, just last year was a one-off. So we're talking here about the actual real tax numbers that we might expect. So effectively, we are back to normal. Now, if we then look at the earnings per share, I mentioned already on a GAAP basis, it's 1.13 euro. So there's also a consolidated view on the earnings per share. Let me show you. So what you can see here, if you take the post-tax impact of non-underlying items attributable to shareholders there, you get a higher underlying profit, and therefore the underlying EPS is 1.34 euro compared to 1.33 euro last year. For me, these are just costs. We shouldn't even be bothered about them. The company wants to show them to us as if it was comparable. Well, it's up to them. But let's say that these numbers look a little bit better. Now, if we then go quickly to the balance sheet, there's not really a lot to highlight here, except for, again, typical working capital topics. They have more inventories, 1.2 billion compared to last year. They still need to chase their customers to pay the bills, and their cash went up. This has also to do a little bit with the refinancing of debt. Other than that, the balance sheet looks good, nothing really worth mentioning. So if we then look into the cash flow numbers, there's still one little thing that I would like to highlight. So all in all, if we look at it, right, cash flow from operating activities is 3 billion, approximately the same as the first half last year. And the capital expenditure of 593 gives us a free cash flow of, let's say, 2.4 billion for the first half year. This is not a lot, but also have a look at their own free cash flow calculation. What we can see here is that they have a bit of a higher cash flow from operating activities because they added back the income tax into the number, but then they deducted it again. I don't know why they're doing this. Capex and interest paid, so they say 2.3 billion for the first half of 2022. And this is probably important to mention because if I value a company, I use free cash flow numbers. So let's quickly look at what my estimate was for Unilever before going into this earnings report. So guys, I was using a free cash flow based on last year of 6.5 billion. It's currently probably, if they would do the same free cash flow in the second part of this year, coming out at around 4.5 to 5 billion. So I've been overestimating, at least for this year, the free cash flow. With a growth rate of 5% to 3%, having this baseline and a 10% discount and terminal multiple of 16, I was estimating the company to be having a fair value of 39. Now, I'm not every year or every half year or after every quarterly report updating my free cash flow numbers because I'm using here a 10-year approach. However, if the company at the end of the year and also with their guidance for next year is not able to make this number of 6.5 billion, I will need to reduce my expectations for the company, which would mean that probably the company and the shares are way more overvalued than I have initially even estimated. Hence, I want you to know this. This is how I look at it. I'm a long-term investor. I'm not switching straight away my philosophy towards the company. However, it is important for me to monitor their free cash flow numbers. So guys, to conclude, is Unilever weathering the storm? I believe so. They have shown really good brand power. Otherwise, they wouldn't have been able to improve the prices and hike the prices with almost 10%. However, I want to see better cash flow numbers. So it's a bit of a mixed bag, but I would say bottom line, a really positive earnings report for Unilever. If you don't agree with me or if you agree with me, let me know in the comments. If you like this video, hit the subscribe and like button. Guys, see you next time.